One of the questions I get asked all the time is, how do you stay in profitable trades longer and avoid closing them too early? There's nothing more frustrating than closing a profitable trade too soon and then watching all that potential profit that you've left on the table just drift away right before your eyes. But it's something that most traders experience all the time. And I've talked about in a previous video, which you can watch up here, how most traders create these lose-lose situations for themselves, so they end up in this perpetual state of frustration. But in many cases, it's completely avoidable, and all it requires is for you to make some adjustments to your trading approach. So let me walk you through the three main things that help me to stay in profitable trades longer and make the most of the opportunities that I'm trading. The first thing is a simple rule that I try to stick to, and I always encourage other traders to try and stick with this rule as well. The rule is, whenever you make a decision or take an action in the markets, you should already know when or where your next decision will be made. There shouldn't be a moment when you're in a trade and you don't know when your next decision needs to be made, because if you do that, you're just going to be reacting to every price move that happens and end up making decisions based on knee-jerk reactions or just gut feeling. So your next decision point might be based on a certain time or amount of time that's passed or a particular price point, but either way, it needs to be based on something logical. So for example, if your next decision point is going to be based on time, it would be logical if this is because that time is close to the end of your trading session and you need to make a decision about whether you're going to stay in the trade overnight or not. Or it might be that there's an economic data release at 1 p.m. and you want to make your decision 15 minutes before that about what action you should take with your trade, whether you're going to scale out, move your stop loss, exit the trade, just hold on, and so on. And if it's based on price, it should be related to a logical point in the markets, either a point where you expect a shift in activity could take place, or where the expectancy of the trade is going to change in some way. An illogical example would be the point on the chart where your profit is a round number, like £1,000. That's what a lot of traders do. They'll set their profit target or make their next decision once they've hit £1,000, whether they've planned it or not. But that bears no relation to the opportunity itself. It's not a logical decision point, it's just an emotional one. So the idea is that when you make these decision points, or when you set where they're going to be, you then don't make any decisions or take any actions until that point or that time is reached. Otherwise, you're likely to be deviating from the logic of the situation and just being reactive based on emotional responses to the price movements that you're seeing. And of course, if your decision points are leaving you exposed for too much time, then you just need to go through an optimization process at some point down the line and fix that, so you can have logical decision points that are not leaving you exposed for a lengthy amount of time and missing out on all the action of the markets. And by the way, if your decision is to take no action, like you've decided, okay, I'm going to do nothing, I'm going to leave the trade as it is, that still counts as a decision, and you should already know where your next decision point is going to be. Never leave it open-ended. A few years ago, I released a video that's completely about this rule. So if you want to go into more detail, have a bit more depth, just click the video that's linked up here. But the thing is, many traders can't follow this rule because of the way that they're trading. They use something that I call a setup-based approach, which you may have heard me refer to before. It means that the entire opportunity relies solely on the setup itself. So in other words, they find a setup for a trade, and when they enter that trade, they set their stop loss and their profit target, and then it's like set and forget, hope for the best. Now, a lot of the time, the profit target is also really far from the price. Either they're feeling ambitious about it or greedy. It's like a 1 to 10 risk reward or even higher than that. And technically, they're meant to just leave the trade to either hit their stop loss or their take profit level. So they're hoping that that setup that they found is enough to cause that hugely asymmetric move. The problem is a lot can happen between your entry point and a profit target that's far from the current price. The context of the market could change. Events could take place, like economic events, or the price might just hit an area where a shift in activity is expected. And without these things being factored into your trade strategy, you're just leaving yourself exposed. And this is why a lot of traders end up closing their trades too soon, because they can sense intuitively that there are things that they're not accounting for in their analysis of the opportunity. They can sense that the market has changed since their setup, and waiting for that profit target might not make sense anymore. But at that point, since it's not part of their plan, either they wait for the profit target regardless of what happens, or they trade based on a gut feeling, which might not be logical, might not be the best thing for the opportunity. So they're caught in this kind of catch-22 situation. So instead, you can factor all of this into the way you analyze the opportunity and plan your trade. so you can have more frequent decision points while still keeping them logical. And all of this relates to the second thing that stops me from closing profitable trades too early: estimating the probabilities of potential outcomes. When you enter a trade with a setup-based approach, you're making a statement, whether you realize it or not, that there are only two meaningful potential outcomes for the next price moves: the negative outcome, which is where it moves to your stop loss, or the positive outcome where it reaches your profit target. But what about all the things in between, like we just discussed? Like, what if the price moves heavily into a profit for you, but it hasn't quite reached your 8R profit target? Instead, you're up 5R, and the price interacts with a path of resistance where you expect an activity change to take place, like interacting with an order block of some sort. So the price then may move all the way against you and lead to a loss because it didn't reach your profit target. That's a potential outcome that you could have planned for that's not factored into your setup-based approach. And when this happens more than one time, you start getting that gut feeling every now and then that maybe you should close your trade too early. But at that point, it's not necessarily logical. You don't have any sort of basis for it, so you're going against your trading plan. You're kind of caught between two different ideas there. So instead, I use a context-based approach where my decisions are always based on the next logical potential outcomes. So maybe I think that ultimately the price will eventually reach all the way up here, but I know that there are a number of areas that could lead to a shift in activity between the entry price and that point over there. So there are a bunch of potential outcomes along the way. So I can assess where those potential outcomes are and then estimate the probabilities of each of the outcomes playing out. I start with the first order outcomes, which is the immediate move, and then I look at the second order outcomes as a conditional probability of the first order outcome, and so on and so on. And this achieves a few important things for us. Firstly, it allows us to figure out the expectancy of the trade based on different orders of outcomes, so we can tell if it's a viable opportunity in the first place, if you even should be trading that. Secondly, it shows us that the further we go from the current price, the further out we go, the more inaccurate our probability estimates will be. So when you have a profit target that's like 10R or further, you're likely relying on luck a lot more than you think. Unless you're talking about like a long-term opportunity for which you have solid fundamental analysis where you've assessed all potential outcomes, assigned probabilities to each of those and so on, that's a different story. I'm talking about with technicals. And the third thing is that it allows you to hold on to the trade for much longer and wait for those outcomes to play out, because when you've estimated the probability of an outcome, it changes your mindset. In fact, it changes the way your brain processes, and we've talked about that in a previous video as well. But you're no longer trying to guess when you should get out of the trade to make sure that you can bank a profit. Instead, you're trusting in your probability estimates and letting the outcome play out regardless of whether it's in your favor or not. And then you can calibrate your accuracy over time, the accuracy of your probability estimates, to ensure that you're getting more and more accurate, so you can depend on these estimates more and more in future. Now, if this is your first time hearing me speak about all of this, well, first of all, welcome to the channel, but also I'm sure you have questions and objections and things like that. So if you want to know a lot more about this approach, check out the link below to my free masterclass, which is a lot longer and a lot more detailed and is likely to address a lot of these areas that you're not sure about. So hopefully you can see now how these first two tips work hand in hand. A context-based approach means you're looking at the next potential outcomes and making a decision about your trade based on those. Now, in most cases, a logical decision point will be once an outcome has played out. Then you can assess the next first order outcomes and beyond to figure out the expectancy and see if it makes sense to carry on holding the trade, to exit, to make a risk adjustment, either by moving your stop loss or scaling in, scaling out, that kind of thing. It's based on the outcomes. And that brings me on to the final tip. If you're using this approach, your decision to scale out of the trade will be based on the next potential outcomes and what that means for the expectancy of your trade and whether you need to reduce your risk. But if I want to hold a profitable trade for longer, I'll sometimes scale out of the trade even if it doesn't fit the logic of the opportunity. Instead, it's logical from a psychological point of view. So when you scale out of a trade, it satisfies your need for instant gratification and other psychological factors. It's the equivalent of a kid taking a nibble of the marshmallow in the Stanford marshmallow experiment and then waiting for the second marshmallow after that. So if I think that I should be holding the trade longer, but I'm feeling that urge to bank a profit, which is completely normal. I mean, we're all human. We have those feelings like loss aversion, instant gratification, and so on. Well, I can just take a nibble off the trade to satisfy that urge and let the rest of the trade run. So even if it's not logical for the opportunity, I'll sometimes do that anyway, just knowing that otherwise I'm going to get in my own way. And if you want to know more about that and some more tips for letting profitable trades run that relate more to the psychological side of things, I'd recommend watching this video next. Thanks for watching.